Well, hello, Maverick traders. Welcome out to your market roundup for July 12th. Corey Halliday here with you. As always, a quick reminder to make sure you follow your trading plan. Markets are moving into earnings season. We're going to get second quarter numbers starting this week, really, and that's going to be a driver of markets as well as some other factors. Currencies are coming into play and certainly having an impact. You can look over here, see the downturn that the market's made today. Dow down 0.5%, S&P, NASDAQ down about 1%. Oil got slammed down 8%. We'll come into the heat map in a little bit. It was kind of a mixed picture. Certainly more red in energy. Advanced decliners, 55% decline versus 39% advancers, and still in a downward trend with about 7 out of 10 stocks below their 50-day moving average. But here is the story, and I talked about this last week. We hit the number. So we talked about the US dollars just on this ramp higher. Euro is cascading lower, and today we hit parity. What is parity? 1-to-1. So you can now exchange $1 will get you €1. It used to take $1.04 a couple of weeks ago. And before that it was $1.08. Before that it was $1.15. Before that it was $1.20, and so on. It took a lot more US dollars to get a euro. Now it's traded to parity, which really speaks to a couple of things. One, that the market's nervous. The US dollar is a safe haven. They are rushing out of euros and into dollars. Europe just has an energy crisis. It has some issues going on. Russia, Ukraine, all of that is not helping. And when the dollar ramps like that and rallies so sharply, it's hard on commodities. And oil fell by 8% following a crash. So as we look at it, you know, in terms of price action, in terms of expectations for what happens next, I do think that now we've hit parity. That was kind of the key level. That was the psychological number. And now that we've done that, actually commodities should probably, I wouldn't be surprised, let's put it this way, if oil had kind of its low and its flush out and its exhaustion today on big volume. But we'll touch on that more. Let's go to the S&P chart, and as you can see here, we're in a downward trend. We've been consistently making lower highs and lower lows. For the past few weeks, I've said you're in one of two camps. As we pull back here, you either think we're just going to go back to the lows and go through it, or we're going to set a higher low and bounce. And I was in that camp. I expected the bounce. We got the bounce. Now, you know, where do we go from here? This is actually a key level just at the 20, because it's probably going to determine whether we can establish a new higher low and push back up to that trend line. So I would expect it. I would lean that way. The CPI will probably dictate that tomorrow morning. The CPI is expected to be bad, primarily from oil, but we just saw oil fall 8% yesterday. So I think markets are already kind of saying, hey, gasoline prices, some of those things are going to back off with all that oil and these commodities have fallen. So yeah, there's a little lag yet, but I actually think it's kind of a situation where maybe the markets rally off of the CPI, realizing that all of these things have hit their peak and have actually come down significantly. So inflation has already hit peak levels. It'll have a little lag. The headline number tomorrow is probably going to be ugly, 9% annualized inflation and so forth. But I think the markets already realize that inflation's come off, that the Fed's going to kind of take the foot off of the brake. They've been, you know, pushing interest rates higher and really nervous about it. Now the Fed doesn't, the markets have kind of taken care of that. The Fed doesn't have to be as aggressive, which I think that will still bounce up towards that trend line here. As we look at the NASDAQ, same thing. We're kind of right at that 20. Tomorrow's going to be key, but I would expect we get that rebound and a little bit more follow through, but it is more difficult for the markets here. It's not as easy a run. As we look at the heat map, really more red in energy. Now, Do you have to rush out there to buy? No. And in fact, usually when you kind of have a big sell off and you're hitting exhaustion lows, you go more sideways initially. So these need time to kind of work out their bottoms and really establish some patterns that we can buy into. But I do suspect that energy is kind of at least temporarily flushed out to the downside. I'd expect a lot less selling pressure in oil and oil related assets with the dollar hitting parity. I would also say, kind of the same thing is true for precious metals, but precious metals are in a worse spot. When the US dollar is strong, that's bad for gold. When interest rates go up, that's bad for gold because it's competition. And so I think gold has a lot of headwinds. Energy, I mean, these companies are in great shape. Even with oil at $90 a barrel, they're making a lot of profits. So it's not like they're in the crisis they were in 2020. They're actually in a position of strength. And if you look at their earnings projections for the year, they've been ramped up dramatically. So I think oil has been in that downtrend. It's a lot of US dollar related. It's a lot of inflation coming off, but I suspect we've probably hit a temporary low. So weekly outlook, a little tough here. We've already made the correction. This rally was kind of easier to trade, I feel like, than the next one. But I still lean towards thinking we're going to go up a bit further before this corrective pattern is done. I'm not aggressive in that stance. I was more aggressive in terms of buying this low than I'll be here, I think. But I am looking at it as an opportunity. So let's take a look at, bull and bear ideas here. On the bull side, you'll notice a little bit more focus on biotech. And on the bear side, just kind of a mixed picture. So Biogen is on the bull list. Now, we've had healthcare related, biotech related stocks for the past little while. In fact, I may have even highlighted Biogen right here. I know it was on my personal watch list, but even if we didn't, you're probably about as far back as you're going to go. I think we still are going to push up there and test 225 before there's any real correction. As I see it, this is forming the cup of a potential cup and handle, but I think it's an relatively easy path still for this stock to go up there to 225. Google, as we look at this one. So what do I like about Google? Well, interestingly, I like that they're splitting their stock, and it happens on, is it Thursday or Friday? I think it's the 15th, which would be Friday. But anyway, it's later this week. They'll actually institute the stock split. I think we may dip a little further tomorrow and kind of create a candlestick formation here. And I suspect post-split, this stock should work its way higher. There's going to be earnings and things like that for all of these companies, but I like the Google setup. You can see the bearish to bullish reversal. You can see how it's not really ramping up much, but it is climbing. And this pullback should be looked at as a buying opportunity in my view. So Moderna, we've had on the watch list from back here on the breakout. Now it's already gone up a lot, so if you were in it, what do we do here? I think you stay long. I suspect we're going to go up there and touch 185 or so here in the short term. So if you're not in it, it's kind of tough risk to reward, but you can still probably play it for about 12 points of upside, which is pretty good. I just don't think it's going to give back much ground. Another day or two of stabilization or something possible, but I suspect it'll still have another push up there to about 185. Let's go to the bear list and CRM, Salesforce.com. What I'm seeing here is a series of lower highs and higher lows that seems to be breaking to the downside. So I think this area of the market, Salesforce, Adobe looks bad. Some of these, I would call them older tech. They're not super old. They're not the Intels and the Ciscos of the world, but they've been around for quite a long time, but still trade at really expensive multiples. Salesforce being an example of that, and just not the type of stock that I think works in this environment. It's kind of got some issues, I think, in terms of its technicals and its fundamentals and whatnot, and I expect this to trade to the downside. I'd put NVIDIA and some of those things in the same category. Home Depot, nice bearish reversal, bearish engulfing formation right against the 50-day moving average, and looks like a setup to trade back towards the lows. So if the market goes up, some of these price patterns may not hold, and we'll have to see some confirmation here. But if you see the market rolling over, couple to take a look at: CRM and Home Depot. And then last but not least, we highlighted Newmont Mining, Barrick Gold, some of these gold ideas, and it's just not an area that's going to work in this environment. We've broken levels of support, and it's just in this free fall, and it has the risk of cascading here, where you get big selling pressure, panicky selling, liquidations and whatnot. So this thing may go and may go rapidly. I think last week when we talked in the market roundup, most everything we highlighted on the bear list was not quite ready. You know, Nike, I remember talking about, well, it should bounce first and then we'll short it, which, by the way, it did set up later in the week. Newmont Mining, I remember just saying, hey, this is just ready. I think you just continue to trade this thing to the downside. And sure enough, it's continuing to go. So anywhere you short it in here, you probably got a good trade working. I'm in a bearish position and targeting lower prices and think that's the right idea. So as we look at the markets, they've corrected, they've done the ABC. Gets a little more difficult, but from a broad market perspective, I think we can hang in there. There's certain segments of the market that look better than others. Gold, for example, I wouldn't try to think there's any sort of stabilization in that. Oil, on the other hand, I think the short trade, the bearish trade, is probably past. Now they go through more of a sideways phase, and then quite possibly another bounce later in this year. CPI comes out tomorrow, big headline number, and people are going to freak out, but don't be surprised if the market ends up rallying on that. Retail sales on Friday, and as we said, earnings are here. So earnings, we've got Citi and Delta and JP Morgan, Morgan Stanley, Taiwan Semi, United Health, Wells Fargo, and many more. Next week, we get large tech companies, consumer names, all sorts of things. So earnings season is here. The good news for the markets and some of these commodity trades and things is that at least now that we've hit parity in the US dollar euro, which is kind of where the market was just cascading to, now there should be a little bit of exhaustion there. If you want to play short commodities, I still think it's gold and silver and the precious metals that make the most sense on that side. Hope you've enjoyed the market roundup. Have a great rest of your week, and we will see you next time. Goodbye, everyone.